All right, so here's day 19 of my journey to a $500,000 stock market portfolio. So let's start with the equity. So obviously the markets went up yesterday. I'm recording this video September 6th, pre-market. So obviously when the general market goes up, my equity goes up. So let's see where I'm at today. 7042 from my margin account, 51915 from my TFSA, 17063 from my RSP. So that's a total of 76020. So you could see the difference just from 1 week, just because of the general market. The SPY went from 289 to 298 in the same week. Unbelievable. And it's still going strong today. Pre-market Friday, September 6th, 298.5. All right, so first interesting trade I did yesterday was an earnings trade. I don't normally like to make earnings trade. I actually promised myself that I wouldn't be doing earnings trade. But I was so bored yesterday, there was nothing to trade because everything was just so expensive. Everything went up already. So I couldn't find any covered call trades, couldn't find any credit spreads either that made sense, premium-wise. So I did an earnings trade on Lululemon. As you can see here, when I placed the trade, Lululemon was trading at around 188. I did an iron condor expiring today, so just 1 day expiration. And I went, the short strikes that I picked the short strikes at expected move. So basically I looked at the premium that I could collect from selling the at the money put strike and at the money call strike. So I looked at how much premium I would get if I sold the 188 put and the 188 call. I added them up together and then I took that total, and that was my expected move on each side. So I went to, and I might have added a little bit more just for extra protection. So I basically went 20 points away on each side. So I went to 167 on the low side, as you can see here, 167.5. On the call side, I went to 207.5. I collected $90. As you can see, the difference between the strikes are $250, so 2.5. So my max loss is the difference between $250 and $90. So my max loss is $160, and that happens if Lululemon is trading way above 207.5 or way below 167.5. So remember yesterday was trading at 188 when I placed this trade. So I'll have to wait till the market opens today. So still have about 2 hours to go. But right now, Lululemon is trading at around 197. So right now I would be safe, but anything can happen when the market opens. Right now I would be able to keep the full $90 if Lululemon stays at that price come market open. But that could only be confirmed when the market opens. Either I'll let it expire worthless, but most likely I'll try to close it, even if it's for $5 or $10, just to remove the risk off the table. It's still going to be a good return on capital in 1 day. So you also know I had a Netflix put that got assigned. So I ended up owning 100 shares of Netflix. So I got rid of that position by selling it back to the market and using my 315 put for protection, which ended up giving me a $500 loss. I also closed my American Airlines covered call trade early. I think this one I had placed here. Let's look. I think I had placed like 2 weeks ago. Yeah, so you can see these 4 lines, the 4 first lines here. This is the American Airlines covered call trade. So I placed it August 27th and closed it September 5th. So exactly 1 week. So this was a 1 week trade. So I basically bought the stock at $24.73. I collected $128. And then I had to buy back the option at $3.56 because the stock went up. But I sold it for a higher price because the stock went up. So I made a $90 profit in 1 week on an initial capital of about $23.50. So 3.8% in 1 week. So my initial expiry date on this covered call trade was September 27th. So I still have about 3 weeks to go. Yeah, I still have about 3 weeks to go. But because the stock went up a lot, I was able to close this trade early. So I actually made my max profit of about in 4 weeks. I ended up making it in 1 week with this trade because the stock went way over my strike price. So I'm happy. I got my expected 4-week profit. I got it in 1 week. But what I care more is that it's 3.8% in 1 week. And if we want to remove commissions from that, so it's $90, the commissions would be about $6 twice. So 90 minus 12. So that's $78 profit, net profit from the American Airlines trade that I've made last week. And then I've got Nvidia here, which I absolutely love. I wish I could trade Nvidia every time, but now it's trading way too high. But remember, here, let's filter on Nvidia. All right, so let's look at the first 4 lines on Nvidia. So August 23rd, which is exactly 2 weeks ago. So exactly 2 weeks ago, I bought Nvidia at 163.75, but then I sold a call option at a 155 strike. So as you can see, the strike is lower than my purchase price. I went lower than my purchase price. I went in the money because the premium was so high. It gave me enough room to go in the money, but also collect the profit. So I gave myself more downside protection while also making a profit, because that's what I'm worried about. I'm worried about the market crashing. I want to make a profit even if the market crashes. Now, of course, I would have made way more money if I had just kept the stock, or if I had sold a call option at a strike that's higher than my purchase price. But I don't know what's going to happen, and I don't want to make assumptions. So if I'm going to make an assumption, I'm going to make the worst assumption, which is that the stock is going to go down. So to give myself protection in case the market goes down, I'll pick a strike price that's lower than my purchase price if it's the beginning of a trade. If it's my first trade with a stock, I'll pick a strike price that's lower than my purchase price, so 155 as you can see here, as long as the call premiums collected compensate for the difference. Because I bought the stock at 163, my strike is 155, so automatically there's an $8 loss here. But I collected $12.87, so the difference between 12 and 8 is my profit. So I bought the stock at 163.75, but I collected $12.87 at a 155 strike. So my cost is 150.88, but my max selling price is 155, which is a strike that I sold it at, the call option at. So if Nvidia is trading above 155 come September 20th, regardless if it's at 180, 190, 200, my max selling price is 155. So I make an upfront profit of about the difference. So 155 minus 150.88, so about $412. That's my max profit. But I make it in many different scenarios. I make it if Nvidia goes up, I make it if Nvidia stays put, and I even make it if Nvidia drops from 163.75 to 155. So that's why I like this type of trade, because it covers me in many different scenarios. Plus I get my profit up front. So this was an expected profit. I was expected to make $412 or confirm it by September 20th. If Nvidia is trading above 155 come September 20th, then the trade is confirmed. I get my money back. I already collected the premium, but my money is still in the stock. But if Nvidia is trading above 155 come September 20th, I get my money back at 155. So the trade is confirmed. But now, because yesterday Nvidia was trading at 179.33, I had a chance to close the trade early, like I closed American Airlines early. Now let's look at the profit I was able to make by closing it early, 2 weeks early. So remember, I placed the trade August 23rd. I closed it yesterday, September 5th. But this trade going in, I was expected to make my max profit at September 20th. So I closed the trade 2 weeks early, or I had it for only 2 weeks as well. And let's look at the profit I was able to make. So 0 minus 16375, because that's how much money came out to buy the stock. But then immediately I collected 1287, and then I had to buy back the call option because the stock was trading way higher. Bought it back at 24 480, but then I sold the stock at 17933. So I made a profit of 365 in 2 weeks, while I was expecting to make a profit of $412 in 4 weeks. So going into this NVIDIA trade, my expected profit was $412 in 4 weeks, but I got the opportunity to close the trade early for a profit of $365 in 2 weeks. So it didn't make sense to wait an extra 2 weeks just to collect an extra $55. So 365 divided by 412. So I already collected 88% of my max profit in half the time. So that makes absolute sense to close it early. Now let's look at the return on capital. So 365 was my profit. If we remove commissions, it's going to be about $12. So 353 is my net profit divided by my initial capital. So my initial capital was 15088. So that's 2.3%. That's a 2.3% return in 2 weeks, which is lovely. So divided by 2 times 52, that's an annual return of 60% just with this trade. So yeah, I'm definitely happy with that. And as you can see, Lululemon's already slightly dropping down to 197. I just needed to stay below 207. I don't think I'm going to be worried about the put side because it looks like it went up after earnings. But let's just hope it stays below 207. So the other trade I made is I closed one of my put credit spreads. Remember this September 23rd put credit spread on the SPY at 275? This was actually part of an iron condor. It's a good thing I closed the call side because the call side was at 300. So I would have been completely tested on the call side, definitely losing money on the whole trade because of the call side. So I'm really happy that on Tuesday I closed the call side, not even for a loss, for break even. And so I ended up with the put side, which was completely profitable. I ended up closing it because I still have 3 weeks and I know that anything can happen. So got to confirm my profit. So this one, I believe, was a profit of $83, a max profit of $83. I ended up closing the trade for the difference here, 32 minus 19. So I ended up closing the trade for $11 plus commissions of 6. So I ended up closing the trade for $17. So this put credit spread here gives me a profit, total profit of, I think initially, I think it was $83. So minus the $11 for closing the trade early, and then the commissions, of course, so minus $12. So it's a $60 profit on a capital, though, on an initial capital of $417. So 60 divided by 417, so that's a 14% return. And this, if I remember, when did I place this? So I closed it yesterday, but I think I placed it quite early, quite soon. So I placed it August 23rd. So I placed it August 23rd, as you can see here, September 23rd, 275, 270 put. It placed it August 23rd, closed it September 5th. So yeah, that's 2 weeks. So that's 15% in 2 weeks on this trade here. I also closed my Tesla put credit spread early. If you remember this one I collected $100. As long as Tesla stays above 200 come September 20th, I keep my max profit of $100. And I know Tesla can move like crazy, so I wanted to close this trade early for sure. I think Tesla was trading at 220 in the 220s yesterday. It didn't go up as much as the other stocks. So I closed the trade early, I think for $45. So I collected $100 to open the trade, and I closed it for $45. So 100 minus 45 is 55 profit minus commissions of in and out, so about $12. So left with $43 net profit on an initial capital invested of $400. So this is going to be an investment of about a return of about 10%. And I think this was about 3 weeks, actually 2 or 3 weeks. Let's see. Yeah, so the initial trade was opened August 21st. I closed it September 5th. So this is about 3 weeks. August 21st. Actually, it's 2 weeks. Sorry, so this is 10% in 2 weeks as well. So really can't complain, although it's small dollar amounts, but it's the concept that I'm talking about, the trade, the return on capital. If I could do this many times, this isn't worth anything if I just do it once, but if I do it many times with almost all my capital, then it's amazing. And if I stop buying crappy stocks and losing so much money on them, I think overall this would be a very good strategy. I mean, if you look at my positions and my margin, and if I put them in order of losing trades, you can see United States Steel, I'm losing $2,600 US, so that's annoying. Kraft Heinz, $1,800. Uber, not too worried about. SNC, not too worried. Box, not worried. Zillow, not worried. But as you can see, they add up. Zillow, not worried. Goodyear Tires, not worried, I guess. And if we go to my TFSA, so that's just my margin. If we go to my TFSA, I've got Teva. Teva, I don't know what's going to happen with Teva. I know it's a great stock, but why is it down so much, and will it recover? I don't know. But right now I'm down 2,800 on Teva. Grubhub, I don't think I'm worried about Grubhub, but I'm down 1,400. Macy's, I'm worried because it's retail. Might take a while before it comes back up. I'm down 1,300. And then the biggest loser is in my RSP, Novavax. I'm down 5,400 US. So these were the trades that I made yesterday. Today, I'm trying to close EWZ, but the order doesn't want to get executed. I think there's not a lot of volume on the option side for EWZ. So I'm not able to get out of it early. So Lululemon, hopefully I'll try to close it for a profit. Hopefully it stays below 207. It would be a good earnings trade. So the reason I placed this trade is because yesterday I was just closing trades early, but I didn't make any new trades. So I felt like I had to make a trade. Like the market went up, something has to be done. There was so much movement, something has to be done. All I was able to find was this Lululemon trade. And the reason I placed this trade is because statistically speaking, I think there's 75% of the time, stocks after earnings do not go outside of expected move. So if you place earnings trade enough times, as long as you pick expected range, 25% of the time you'll lose, but 75% of the time you'll win. And with this trade, my max profit was $90 and my max loss was $160. So I didn't go 5 point wide. I only went 2.5 point wide so that I don't lose much in case I'm in the 25% probability. In case Lululemon falls in the 25% probability where the stock moves outside of expected move after earnings. So I felt like $90 versus $160, it was a fair trade-off, especially if I have a 75% chance of making $90 and a 25% chance of losing $160, right? And if you look at the probabilities, 0.75 times 90 is $67, while 0.25 times 160 is $40. So the difference over the long run, if I keep placing these trades, I'd make my profit would be the difference of 67 minus 40, or 27 over 250 return wise. So it's about 10%. So if I keep making these earnings trade in the long run, my return would be about 10% of the width of the strikes. Now you can see Lululemon's up to 198, so it's starting to bother me. Looks like it wants to get closer to 207. As long as it stays below 207.5, I'm safe. But I'm definitely gonna try to close it early. As soon as the market opens, I'll just close the trade early for whatever it's trading at. So usually the premiums, there's gonna be a drop of volatility after earnings, right? So the premiums are gonna drop. So I could buy back the trade for much less than what I sold it for. I sold it for 90. Hopefully I can buy it back for $10. And if I leave it till end of day, as long as it stays below 207.5, then my options expire worthless. I keep the full 90 and I don't have to pay commissions to buy back the trade. But don't want to take the risk. Lululemon could start off the day at 198, 199, but then end the day at 208. So I'd rather close it early if I have the chance. I'm also going to try to close my put credit spread on the Qs. This is a trade I placed this week and I collected $64 and I have a chance to close it yesterday I had a chance to close it for $25 about, So I'm going to try to close it early. It's going to be a small profit, but it's hard to ignore this rally. If I have a chance to close my trades early, I will. All right, so there's a car honking outside. Car's alarm. So I'm going to end this video. So if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.